Hello students, here is your another video for your online class, and come join me in class 11th accountancy course. Students, we are still continuing with unit 1 basic terms of accounting. Like I told you earlier that we have about 20-25 terms that we have to learn before we go further into real accounting, and so today we'll continue with the basic terms of accounting. We'll learn the sixth point, liability. It refers to the amount which the firm owes to outsiders. Now we have learned about the assets. Assets are those property that you own or you have got the possession, or what you have with you which helps you to earn money in future or which gives you benefit in future. That is called your asset. On the other hand, liability is the amount that the firm has to give to outsiders. They owe to outsiders or others. Now in the balance sheet, liability we can find out by deducting capital from assets. Now assets, we have already learned that it is what you own which helps you to get future benefit, and so all the assets that you have, and you minus it from your invested amount, that is capital, and finally you will get the liability, how much money you have to owe or give to others. Liability may be divided into two parts. Internal liabilities, all amounts which a business entity has to pay to the proprietor or owners, such as capital, accumulated profits. So now the liability or the internal liability is what the business entity has to pay to the owners or proprietors. Now you might get confused. You might get confused that how the owners will be paid, because they themselves are the owners of the companies. So here let me again tell you what we have already learned in the phases of evolution of accounting, and once again let me tell you that business entity and the person who is running the business, the owner of the business, are separate than each other. The business entity is an artificial person which functions separately like a person, but it is an artificial person, and the person who runs the business or owner of the business is separate. So when the person will run the business, they will assume that they are a part of a business. So whenever the business will do any profit, or when the business will earn any amount of money, the business has to give this amount of money to the owners or the proprietors, and so we call it as an internal liability, because the owners or the proprietors are directly attached to the business entity. So here don't get confused. The business entity and the person running the business are two different persons. The business entity has got a separate identity. They are the separate artificial kind of person, and the person who is running is separate. They behave as if they are the part of the business. External liabilities, all amounts which a business entity has to pay to outsiders, such as creditors, bank loans, etc. So the second divided part of liability is external. Now the external liability is what the business entity has to pay to outsiders, not related to internal people. It is the external, like the suppliers from whom they have taken goods on credit, the loan they have taken from any financial institution or money lender or bank. So these are the external liabilities. Liabilities may further be classified into long-term liabilities. These refers to those liabilities which fall due for payment in a relatively long period, normally after more than 1 year. Example, long-term loans, debentures, etc. So the long-term liability, now we have understood that liability is what the firm has to give to outsiders or others. So we have got internal liability, what the firm has to give to its owners and proprietors, and external liabilities, what the firm has to give to outside the company, creditors, loans. And then these liabilities can be paid after a long period of time, normally after more than 1 year, which is called as long-term liabilities, like long-term loans, debentures. Now debentures are also a kind of loan taken as a finance for the business, and then it is classified into current liabilities. These refers to those liabilities which are to be paid in near future. So current liabilities or short-term liabilities are those liabilities, like current, the word current is there, so quick. So here the current or the short-term liabilities are those liabilities which has to be paid within a year, like bank overdraft, creditors, short-term loans, like suppliers, they demand for the payment within a year. You have taken loan from the bank, short-term loan, which you have to pay quickly, normally within a year. So the liabilities may further be classified into long-term, normally after more than 1 year, and short-term or current liabilities, normally within a year. Contingent liabilities. These are not actual liabilities on the date or balance sheet, but may become payable only on the happening of some specific events. So there are some liabilities that you have to owe to others. Like there are some liabilities you know you have to pay. Like suppose you have taken goods from a supplier in the month of June, and you know that you have to pay that supplier, because that is your liability that you know about it. If you have taken loan from the bank, you know about that liability that you have to pay. But there are some liabilities which are actually not liabilities, but because of some specific events or some kind of happenings, these kinds of liabilities comes into existence. Examples are bills discounted but not matured. The firm will become liable to pay the bill if an acceptor dishonors the bill accepted by him, her on the due date. So here this bill, what we are talking about is the bills of exchange. When we will go further in this video, we will understand there clearly what is this bill we are talking about. So here the bills of exchange, when it is discounted, okay, and it is not matured. Now when this unmatured bills, it gets dishonored, which means the acceptor of the bill, they refuse, or this kind of bill is been dishonored by the bank, then what happens? The firm is liable to pay the bill amount. Okay, so we'll just get into this whole bills of exchange explanation in the upcoming part of the video. You just understand that a bill of exchange, when discounted but it is not matured, then there will be a liability for the firm. If the acceptor of the bill will refuse the bill, then the firm will have to pay the bill. They will become liable for the bill. If a suit against the firm is pending in the court the actual liability will arise if the suit is decided against the firm. Now suit, if a case is going against the firm and the case is still pending, it is going on, and every year new hearing is coming. Every year the case is still pending in the court, and if finally the case is decided against the firm, then the firm will be liable to pay some amount to the person who is fighting the case against the firm. If the firm has given a guarantee for another person, the actual liability will arise if the person for whom the guarantee is given fails to meet his/her obligation. So here the word firm is not written. So if the firm gives guarantee, like you as a business firm giving guarantee to the other person, but the person for whom you have taken guarantee fails to meet the obligation, like entering into other business, taking loan from the bank. So you have taken guarantee for that person, but the person all of a sudden cheats, or it might be due to some case fails to meet the obligation. In that case, the firm who has guaranteed will have to pay the amount and will become liable. Trade receivables. It refers to the amount receivable on account of sale of goods and services by the company in normal course of business. It includes both debtors and bills receivables. So now trade receivable is the amount that we receive after the sale of goods and services, and we are saying that in a normal course of business. So business is a continued activity. It is not a one time or an isolated activity. We cannot call this business when you sell your second-hand car, or when you have old furniture and you want to replace it with new one, so you sell it. So we cannot call this as a business. For a business, you need to have a normal continuous activity, like you need to open a furniture shop, or you need to be a car dealer to sell various goods and service, and from there the amount which is received in your account is called as trade receivables. Now debtors. The term debtors represents those persons or firms to whom goods have been sold or services rendered on credit and payment has not been received from them. So debtors are those persons. Now debtors are the customers or person or firm that you say as customers to whom you have sold goods and services on credit, and till now you have not received payment from them, so they become your debtors. Now debtors are assets. Why we call them as assets? We call them as assets because you have sold goods and services to them on credit, and you know that in future you're going to get money from them, you're going to get benefit from them. Aman sold goods to Sohan on credit for rupees 50,000. Sohan will remain debtor of Aman as long as he does not make the full payment. So here Aman, the seller, he sells goods to the customer Sohan, and Sohan is buying goods on credit without paying money. So here it says that Sohan will remain the debtor as long as he does not make the complete payment to Aman. So here the customer Sohan becomes the debtor because he has purchased goods on credit and still has not done the payment for the goods that he has bought or purchased. Here you can see one man holding the past due. So this is Aman, let us say, and the other one with the weight of the debt, let us say this is Sohan, who has bought goods worth of rupees 50,000, and he will still be under the burden of debt and remain debtor, the person holding the debt on its back, unless he makes the full payment. Bills receivable. A bills of exchange becomes bills receivable for a person who draws a drawer and gets it back after its acceptance from the drawee. The amount specified in such bill is receivable at a future date. Now earlier I told you that we will understand about bills discount in the coming part of the video. So here let us understand first what is bills of exchange. Now students, it is not that business you have to do in cash, but the business also has to run on credit. So if you have to run your business, so you have to sell your goods both on cash and even on credit. So here the bills of exchange is given between the two person who purchases and sells goods on credit. Like here we can see the specimen of the bills of exchange. Now over here if you see, we have got a bills of exchange, and here we have got signed, and under this we have name Vikas, and here we have got accepted signed, and here we have the name Nishchay. So here this Vikas sells goods to Nishchay on 15th of August 2016. But Nishchay, he says that I will not be able to give you right now, so you give me goods on credit. So Vikas, he writes a bills of exchange. So he writes down that after a specified date, 3 months after the date, Nishchay, who will have to give money, because Vikas is seller here, so Vikas is the drawer, so he is drawing the bill or making the bill and giving it to Nishchay, that you have to give me money after, let us say, here it is written 3 months, rupees 50,000. Now Nishchay is the acceptor or the drawee, because he accepts the bill, signs it and gives it back to Vikas. So here Vikas is having the bills receivable. Like here we say that a bills of exchange becomes a bills receivable for the person who draws it and gets it back. So Vikas is the seller who sells goods for 50,000 to Nishchay on credit, and Nishchay after 3 months will pay him money. So here Vikas, he writes a bill, he makes a bill, and this bill becomes bills receivable for the person who draws it. So here he is drawing the bill, making the bill, and gets it back after its acceptance from the drawee. So here gives to Nishchay, and Nishchay accepts the bill. He says okay, fine, and signs it, and this drawee accepts and gives it back to Vikas. So for Vikas, this becomes the bills receivable. Now trade receivables are amounts billed by a business to its customer when it delivers goods or services to them in the ordinary course of business. These billed amounts has not yet received payment are entered in the accounts receivable until they are paid. Any amounts that are immediately paid in cash are not considered to be trade receivables. So, like we already learned that trade receivable includes debtors and bills receivable. So, debtors are the person or firm to whom goods are sold on credit and yet the payment has not been received from them. In the same manner, bills receivable becomes a bills receivable for the seller. The seller is selling goods on credit, and so the person who buys it promises to pay after a certain time. In the previous example we saw after 3 months. Nishchay, he was the purchaser, so Vikas was the drawer. So the bills receivable is also when the goods are sold on credit. So here each and every amount that is not yet received are entered in the bill amount not yet received is entered in the accounts receivable until they are paid. So any amount that are immediately are not considered as trade receivables. Okay. Trade receivable includes debtors and bills receivable. So both are sold. In both cases the goods are sold on credit. In the first case, the customers or the person to whom goods are sold on credit, and still now the amount has not been received. And in second one also, bills receivable, the goods are sold on credit to the other person, but the other person after a specified period that is written on the bill will pay the amount in the future date. Trade payables, the amount payable on account of goods purchased or services taken in normal course of business. So like trade receivable, we said that when we sell the goods and we receive the amount in the normal course of business, not one time purchasing and selling. It should be same goods which is dealt with purchasing and selling. Like here, trade payables are the amount that you have to pay on account of goods and services that you take in the normal course of business. Like if you have a furniture shop, you buy the woods and planks. If you are the car dealer, so you buy the car. If you have a business of, let us say, clothes, so you purchase these things normally as a daily routine, and the amount that is payable is called as trade payables. It includes both creditors and payables. Creditors, the term creditors represents those persons or firms from whom goods or service have been purchased on credit and payment has not been made. Now creditors are the liabilities because you have purchased goods on credit without paying them money. Payment has not yet been made, so you have to owe to them. You owe to them. So creditors are those person or firms from whom goods or services have been purchased on credit and payment has not yet been made, like suppliers of various goods. Aman purchased goods from Sohan on credit 50,000. Sohan will remain creditor of Aman as long as full payment is not made to him. So Aman, he purchases goods from Sohan. So Sohan is the supplier, and so since Aman has purchased goods from Sohan on credit without paying money, So Sohan will remain creditor of Aman. Now creditor are those person from whom goods and services have been purchased on credit and payment has not yet been made. So here what can we see? That Sohan will be the creditor because Sohan is the person from whom goods are purchased. So as long as the payment is not made to Sohan, Sohan will remain the creditor of Aman. Here you can see the hand, that is Sohan, the creditor, and the other side you can see Aman. So unless Aman clears all the payment, Sohan will remain the creditor, or he will be the one to whom Aman will be liable to pay until the full payment is not. Bills payable. A bill of exchange becomes bill payable for the person who accepts drawee and returns it to the drawer. Thus, bills payable is an accounting term for bills of exchange accepted in favor of creditors. The amount specified in such bill is payable at the future date. Now here we have got another example, but first we will just recall the previous specimen of the bills of exchange. There we had Vikas, who was the drawer, and for him it was bills receivable, and Nishchay, who bought goods on credit, accepts the bill. So Nishchay is drawee, and for Nishchay the same bills of exchange will become bills payable, since Nishchay will have to pay 50,000 rupees after 3 months on the bill. So Nishchay accepts the bill and returns it to the drawer. So for him it will become bills payable, and for Vikas, who was the drawer of the bill, for him it will become bills receivable. Thus, bill payable is an accounting term for bills of exchange accepted in favor of creditors. Okay, so here the creditors are the one who give you goods or services on credit. So here Nishchay, he accepts the bills receivable as bills payable in favor of the creditor Vikas. Now let us look into this. Mr. Sam drawer, he sold goods to Mrs. Reith and draws a bill. Now Mrs. Reith, she accepts the bill. So this is the bills of exchange which Mrs. Reith accepts and gives it back to Sam. Now on the maturity date, payment made by drawee. So here let us say this bill will mature after 3 months. So on the maturity, now this bill is with whom? This bill is with Mr. Sam. Mr. Sam was supposed to receive money, so he writes it down and gives it to Mrs. Reith. Mrs. Reith signs and accepts the bill and gives it back to Mr. Sam. So Mr. Sam on the maturity, that means after 3 months, will get into his bank account, get cash and transaction completed into his bank account 50,000 rupees according to the bill, and so the transaction will be completed. So the process of bills of exchange is any credit sale between two person, like not customers but like two suppliers we can say. So Mr. Sam sells goods to Mrs. Reith and Mrs. Reith says that I won't be able to give now, so you give on credit. So Mr. Sam, he writes down a bills of exchange, draws a bills of exchange. Mrs. Reith, she accepts and signs it and gives it back to Mr. Sam. So this bill now remains with Mr. Sam, and on maturity after like 1st January is the date So after 3 months means 1st February, March, April. Okay, so on after 1st of April he will get into his bank account, and here the cash and transaction will be completed. Okay, now in the previous part of the video we were talking about the discount of bills of exchange. So now let us say that before the maturity date, what happens? Mr. Sam is in great need of money. So he goes and to the bank. He was supposed to go after 3 months of receiving this bill, because Mrs. Reed is going to pay him after 3 months on his account, in his account. So he is in great need of money. So he goes to the bank and he gets the bill discounted. So he will not get 50,000. He will get less than 50,000 because the bank will not give him the complete amount. And on maturity date, the bank will recover money from Mrs. Reed. So when you have bills of exchange before the maturity date, you can go to the bank and get money, but you will not get the full amount. So when you go to the bank before the maturity date and submit the bills of exchange to get money from it, it is called discounting the bills of exchange. Now dishonoring means during that date, now Mrs. Reed says that, or the bank says that Mrs. Reed does not have enough money. So automatically Mr. Sam will not receive money on that date, and so that will become liability for Mr. Sam. So here we have got the bills receivable is for the drawer, and a trade payable is an amount billed to a company by its supplier for goods delivered or service consumed by the company in the ordinary course of business. These bill amounts, if paid on credit, are entered in the accounts payable until they are paid. Any amounts owed to supplier that are immediately paid in cash are not considered to be trade payables, since they are no longer a liability. So similarly, like trade receivable, we said that it was the amount that has to be received on sale of goods and services. Now there were two types of trade receivable, debtors and bills receivable. So trade payable also includes two, that is creditors and bills payable. In both the cases, the goods are purchased on credit. So from the creditors, when we purchase goods on credit, or the creditors are the person from whom the goods are and services are purchased on credit, and amount is still not paid. In the same way, the bills of exchange becomes bills payable for whom? For the person who has to pay money. And if paid on credit, it will be entered in accounts payable until they are made. So every time the cash is been paid, the amount will be deducted from the accounts payable. So trade payables include creditors and bills. Now let us see the basic difference between trade receivable and trade payables. Very easy to understand with the image you can see here. Trade receivable means you are receiving money from your debtors and from the bills receivable that you have. The money owed by the third party to the business. So money that the other person has to give it to you. The account holders are known as debtors. And here in the trade payables, you can see you have to give money to the third party, to others. So account holder here are the creditors. So in trade payables, you pay money to the creditors, and in trade receivables, you receive money from the debtors. Now let us see the difference between debtors and creditors. Meaning, person or organization that has liability to return money to person or an institution extending loan is called debtor. So debtor is a person or organization that has to give money in return to the person who has given loan or money or goods on credit to this person. Creditors, the person or organization which has extended loan or given goods on credit and is liable to receive money, is called creditors. The debtors have a debit balance in the firm, like they have to pay. Creditors have got credit balance in the firm, like debtor is, they have a debit balance in the firm, which means that from them the amount is supposed to be received, and the creditors have a credit balance in the firm, which means the amount has to be given to the person whose amount has been credited. The payment or amount owed is received from them, and for creditors, payment for loans are made to them. The status in the balance sheet, debtors is shown as asset in the balance sheet, like I told you that the debtors are the assets because you know from them in future you will get benefit, and the creditors are shown as liability because you have to owe them in the future. And both comes under the current because debtors also have to be paid within a year and creditors also have to be paid within a year or so. Debtors are an account receivable, like we saw that the trade payables, so the amount that is not received goes into the account receivable, the trade receivable, and as you pay on the cash, the amount will go on deducting. So for the trade payables, the creditors into the account payable. Discount can be allowed to debtors by person who extends credit. So discounts can be given to the customer, like you are giving goods to your debtors, so or you're giving loan so to the debtor who is a debtor, so you can give discount to the debtor on the interest of loan, or you can give discount to the debtor on the goods that you have sold. Creditors, they offer the discount. So here discount is allowed to the debtors. Debtors, they get the loan, and creditors, they offer or they give the discount to the debtors. So here